Let me tell you something that's happening right now that almost nobody in the West is paying attention to, and it's going to fundamentally change everything you think you know about the silver market. China is emptying their vaults. I'm not talking about a gradual drawdown or some normal market fluctuation. I'm talking about a systematic, strategic depletion of silver inventories that has reached levels not seen in over a decade. And the implications of this are absolutely staggering. As of January 30th, 2026, the Shanghai Futures Exchange reported silver warehouse stock of 455.068 metric tons. Now, you might be sitting there thinking, okay, what does that number actually mean? And let me put this into perspective for you. This represents an 85% reduction from the all-time high of 3,091 metric tons, recorded on January 12th, 2021. We're talking about a collapse from over 3,000 tons to just 455 tons in 5 years. That's not a drawdown. That's a complete evacuation. The velocity of this decline has been absolutely breathtaking. Between January 29th and January 30th, 2026, inventories plummeted from 482 metric tons to 455 metric tons. That's over 5% gone in a single 24-hour period. Think about that for a second. In one day, 5% of the visible silver inventory in China's primary exchange just vanished. Now, this depletion isn't happening in isolation. In late 2025, warehouse inventories at Shanghai Futures Exchange facilities hit 531,000 kilograms, marking a decade low point not seen since 2015. These exchange-monitored warehouses serve as the primary source of deliverable physical metal for China's massive industrial sector. When these stocks reach such constrained levels, the market enters what's called backwardation, which is a technical condition where immediate physical delivery commands a significant premium over future-dated contracts. Here's where it gets really interesting. In early 2026, Shanghai silver spot prices were trading at premiums of $5 to $10 over Western paper benchmarks. Think about what that's telling you. The local Chinese market was signaling acute physical scarcity long before Western ticker tapes reflected any crisis whatsoever. While traders in New York and London were looking at their screens, seeing one price, the actual physical market in Shanghai was saying something completely different. To understand how we got here, I need to take you back to October 2025, which market insiders are now calling the Great Silver Squeeze. During this period, a liquidity crisis in the London Bullion Market Association reached a breaking point. Silver lease rates, which is basically the cost to borrow physical silver for delivery, exploded to over 30% annualized. 30%. To put that in context, that's a level of desperation in the physical market that indicates people are willing to pay almost anything to get their hands on actual metal. In a desperate attempt to stabilize global prices and prevent a total collapse of Western delivery mechanisms, China exported a record-shattering 660 metric tons of silver in October 2025 alone. These shipments were strategically timed to ease the London squeeze. But here's the critical part you need to understand. They left China's domestic inventories dangerously depleted. Between October 9th and November 21st, 2025, combined exchange inventories in China collapsed by 48%, falling from roughly 77.5 million ounces to just over 40 million ounces. This massive transfer of metal from east to west was a temporary corrective measure, but it ultimately exacerbated the structural deficit within China. It's like using your emergency savings to pay off someone else's debt. Sure, it solves their immediate problem, but now you're the one who's vulnerable. Now, here's what most Western analysts are completely missing. The data suggests that the visible silver inventory on these exchanges is only the tip of the iceberg. Analysts believe that invisible stocks within China, held by industrial users, private refiners, and the state, could be multiples larger than the exchange-monitored levels. But here's the thing. The fact that exchange inventories have been drained so thoroughly indicates that these invisible reserves are being held tightly, likely due to anticipation of future shortages or state-mandated hoarding. On January 1st, 2026, the Chinese government implemented a policy shift that fundamentally altered the global silver market. Silver was officially reclassified as a strategic material, placing it in the same regulatory category as rare earth elements and other critical minerals essential for national security. This wasn't just an administrative change. This was Beijing sending a clear signal to the world that they intended to ring-fence their domestic supply for internal industrial and military use, effectively severing a primary artery of global silver liquidity. The reclassification came with a strict new export control regime. From January 1st, 2026, only 44 state-approved firms are permitted to export refined silver, and they have to meet rigorous criteria, including an annual refined output of at least 80 tons and established credit lines exceeding $30 million. This policy effectively shuts out smaller producers and refiners who previously supplied Western markets, concentrating the remaining supply in the hands of large state-aligned entities. Let me explain the strategic drivers behind this reclassification, because they're absolutely critical to understanding where this is going. First, photovoltaic dominance. China accounts for roughly 85% of global solar manufacturing capacity. The state views silver as an indispensable input for its solar industry, which is a core component of its green economy strategy. Second, electric vehicle infrastructure. EVs consume significantly more silver than internal combustion vehicles, up to 80% more per unit, due to the complexity of power electronics and control systems. China's ambition to dominate the global EV market necessitates a secured silver supply. Third, advanced defense and AI applications. Silver is critical for guidance systems, drones, satellites, and the data centers required for artificial intelligence. Silver's role in nuclear reactor control rods and advanced chip design has elevated it to a status of national security concern. By prioritizing these sectors, Beijing is ensuring that its high-tech industries are never throttled by the same supply shortages that have plagued Western manufacturers. The invisible inventory in China is likely being diverted to these strategic sectors, which further explains why exchange vault levels have reached such extreme lows. Now, the silver market has been in a structural deficit for 5 consecutive years. The primary engine of this deficit is the global solar industry. In 2024, industrial demand for silver reached a record 680.5 million ounces, with photovoltaic applications serving as the fastest growing segment. By early 2026, the demand for silver in solar applications was projected to account for a significant percentage of global mine supply, largely driven by technological transitions within Chinese manufacturing. Here's what's happening on the technology side. The solar industry is currently undergoing a shift from older PERC technology to more efficient N-type cells, such as TOPCon and HJT cells. While these technologies offer higher power conversion efficiencies, they are significantly more silver intensive than their predecessors. PERC cells use about 10 milligrams of silver per watt as a baseline. TOPCon cells use about 13 milligrams per watt, which is a 30% increase. But here's the real kicker. HJT cells use about 22 milligrams per watt, which is a 120% increase over PERC. The 30% increase in silver consumption for TOPCon cells, which now represent about 60% of mainstream market share, has created a floor for industrial demand that remains largely unresponsive to price increases. Some analysts point to thrifting, which is the process of reducing silver content per cell, as a potential solution. But the sheer scale of global solar installations, projected to exceed 500 gigawatts in 2025, more than offsets any savings made through material optimization. In 2024 alone, China accounted for approximately 170 million ounces of annual silver consumption for solar fabrication, and that figure continues to rise as the global transition to renewable energy accelerates. The price of silver paste now accounts for nearly 40% of the cost structure of a TOPCon cell, yet the demand remains price inelastic in the short term because manufacturers have already invested billions in production capacity that requires silver metallization. This industrial desperation has led to off-take agreements where large manufacturers bypass public exchanges entirely to secure physical delivery directly from refiners. This is directly contributing to the depletion of visible exchange inventories that we're seeing. Now, while Western institutional investors have historically viewed silver as a secondary commodity to gold, Chinese retail investors have adopted a vastly more aggressive stance. This behavior, often described as front-running, involves domestic investors identifying supply shortages and strategic shifts before they are recognized by global financial hubs. The rise of what people are calling silver influencers on platforms like Weibo and Xiaohongshu has fundamentally changed the investment landscape in China. These influencers, many of whom are tech-savvy seniors or Gen Z stackers, promote silver as a wealth god and a necessary safe haven asset. The narrative on Chinese social media emphasizes the historical silver-to-gold ratio and the paper versus physical disconnect, encouraging retail investors to secure physical bars and coins. This movement is fueled by 3 critical factors. First, real estate disillusionment. With the Chinese property sector in a prolonged downturn, retail capital has sought new homes. Silver, being more accessible than gold for the average worker, has become a primary target for capital rotation. Second, the 2025 tax rule change. In November 2025, China implemented new tax regulations on gold transactions. This caused a massive pivot among merchants and retail investors into silver, which was perceived as having a more favorable tax and speculative profile. Third, group buying culture. Mirroring the group buying craze for high-end jewelry, Chinese Gen Z has applied this strategy to silver bullion, creating sudden, localized spikes in physical demand that exchange vaults struggle to meet. Here's what's really fascinating about this front-running behavior. Western institutions often rely on lagging indicators, such as COMEX inventory reports or LBMA vault data, which are updated with significant delays. In contrast, the Chinese retail sector monitors real-time premiums in the Shanghai market. When the Shanghai Gold Exchange premium over the LBMA price widens, which often precedes a global price move, Chinese investors buy aggressively. By the time Western institutions recognize the trend, the front-running Chinese retail sector has already secured the physical supply, forcing Western entities to bid higher for the remaining metal. This retail pressure isn't just speculative, it's a manifestation of a fear of missing out culture that has seen families sell residential holdings to buy silver bullion. As the gold to silver ratio compressed from 91 in mid-2025 to 55 by early 2026, those who front-ran the market saw massive percentage returns, further validating the narrative on social media. As of January 2nd, 2026, the global silver market entered what analysts described as a state of unprecedented structural fracture. While digital ticker tapes and Western derivatives exchanges like the COMEX quoted silver at approximately $71.50 per ounce, physical bullion in Tokyo and Shanghai hit $130 per ounce in the same trading sessions. Let that sink in for a moment. The same metal on the same day was trading at two completely different prices depending on whether you wanted a paper promise or actual physical metal. This decoupling is the result of a massive disparity between paper silver, which is contracts and derivatives, and the actual metal available for delivery. For decades, the global silver price discovery mechanism was controlled by futures traders on the COMEX and the LBMA. The volume of paper silver traded often dwarfed the actual stock of above-ground metal. By early 2026, the paper-to-physical ratio was estimated at 378 to 1, meaning there were 378 ounces of promised silver on paper for every 1 physical ounce in a registered vault. The system relied on the assumption that only a small fraction of contract holders would ever request physical delivery. This assumption failed in January 2026. As inventories in London and New York were drained and China restricted exports, institutional investors lost trust in paper promises and demanded physical bars. In late December 2025, reports began to surface that the COMEX was struggling to fulfill delivery demands for its December silver contracts, leading to rumors of cash-only settlements. A cash settlement occurs when an exchange cannot provide the physical metal and instead pays the contract holder the dollar value of the silver at the quoted spot price. However, since the physical price had already moved to $130 while the spot was at $71.50, a cash settlement represented a significant loss for the buyer. This failure to deliver physical metal at the quoted screen price is the ultimate driver of the market decoupling. When a major exchange cannot deliver the underlying asset, the valuation logic of that asset changes completely. In early 2026, silver began to be priced not as a commodity but as a strategic asset or a hard currency, where the physical possession of the metal became more important than its nominal price on an exchange. The first month of 2026 witnessed what traders are calling a physical run on Wall Street. In mid-January, the silver price broke above $90 per ounce, setting a new all-time high. This wasn't a simple risk-off move. This was a structural credit crisis within the paper silver system. The most dramatic moment occurred when roughly 26% of COMEX's registered inventory disappeared in a single week. Between early and mid-January, 33.45 million ounces of silver were physically withdrawn for delivery. This behavior, where traders pull forward their deliveries and insist on taking custody of silver bars early, is historically rare and signals a total loss of confidence in the exchange's ability to settle future contracts. This run was exacerbated by margin hikes. In response to the volatility, the CME Group raised margin requirements, switching from a fixed dollar amount to a 9% percentage margin and later 11%. While intended to stabilize the market, these hikes force smaller paper traders to liquidate their short positions, adding more fuel to the upward price spiral as they were forced to buy silver to close their contracts. Unlike the Hunt brothers of 1980, who were two wealthy individuals attempting to corner the market, the Hunt brothers of 2026 are sovereign nations like China and Russia, global solar giants and European central banks. Russia allocated over $500 million to silver reserves in its 2025 to 2027 budget, recognizing that the paper game was nearing its end. On January 30th, 2026, the silver market experienced a sharp correction, with prices plummeting nearly 30% from their $121 peak toward $84 per ounce. This crash was attributed to the nomination of Kevin Warsh as the next Federal Reserve Chair, which markets interpreted as a hawkish signal that would strengthen the US dollar. However, and this is critical, market analysts noted that historically, hawkish Fed statements never resulted in a 30% intraday sell-off in precious metals. The real cause was likely a massive liquidation of long positions by bullion banks who were heavily short at lower prices. These banks, facing catastrophic losses as silver neared $100, utilized the Warsh narrative to trigger a cascade of stop-loss orders and margin calls, effectively clearing the decks of retail longs. Despite the paper price drop, physical premiums in Shanghai and London remained elevated, confirming that the physical shortage had not been resolved by the price drop. A critical factor that Western analysts often overlook is the inability of the mining sector to respond to these record prices. Silver production is not a tap that can be turned on at will. Roughly 75 to 80% of global silver output is produced as a byproduct of lead, zinc, copper, or gold mining. This means that for a miner to produce significantly more silver, they would need to massively increase their production of the primary metal. If the global demand for copper is not rising at the same rate, or if base metal prices are stagnant, increasing silver output is not economically viable. Furthermore, environmental, social, and governance limitations and the depopulation of mines have led to a secretly dwindling supply that was masked for years by the draining of above-ground stockpiles. Since 2021, over 800 million ounces of silver have been pulled from global stockpiles to bridge the gap between mine supply and industrial demand. By early 2026, those mobile stockpiles had reached a breaking point. Mexico and Peru, the world's leading silver producers, have faced their own challenges. In 2024, production from Mexican mines recovered modestly as Newmont's Peñasquito mine returned to full operation, but this was offset by an 8.8 million ounce decline in Chile and stagnant output from Peru. Geopolitical instability and labor disputes in these regions continue to threaten the steady flow of concentrate to global refiners. As silver prices crossed $90 and $100 per ounce, its role in society began to change. Jewelry and silverware demand in China saw its third consecutive year of losses, as consumers pivoted to more affordable alternatives or held onto their existing silver as generational wealth. In Shanghai, the disappearance of silver from the retail market was noted by local observers. Jewelry-making communities on platforms like Xiaohongshu began to report that they could no longer source affordable silver grain for their crafts, as refiners were prioritizing industrial offtake and state-approved export licenses. This transition from a public, accessible metal to a quietly disappearing strategic asset is a hallmark of a final stage supply squeeze. The 2026 run was further accelerated by U.S. military operations in South America and heightened tensions in the Middle East. As President Trump signed executive orders imposing tariffs on countries supplying oil to Cuba, a move that added pressure on Mexico, investors responded to rising U.S. fiscal risks and geopolitical uncertainty by rushing into hard assets. The evidence presented in early 2026 suggests that the global silver market has undergone what I'm calling a systemic re-anchoring event. The decade-low inventory levels in Shanghai are not a statistical anomaly. They are a symptom of a world that has realized the abundance of resources can no longer be taken for granted. China's emptying of its vaults was a multi-stage process. First, an accumulation of physical metal while Western prices were suppressed. Second, a record export surge in late 2025 to stabilize Western markets and extract premium valuations. And finally, a ring-fencing of the remaining supply for domestic high-tech and military use. Throughout this process, Chinese retail investors, supported by a sophisticated digital ecosystem of silver influencers, have successfully front-run Western institutions, securing physical allocations while Western entities remained focused on paper-based derivatives. The fracture of the COMEX and LBMA delivery systems in January 2026 marks the end of the post-Cold War era of silver abundance. The 378-to-1 paper-to-physical ratio has finally proven unsustainable, as industrial users and sovereign states insist on the delivery of the metal they own on paper. While the Western financial media may point to hawkish Fed chairs or dollar indices as the drivers of silver as volatility, what the West doesn't know factor is the sheer scale of the physical deficit, and the commitment of the Chinese state to ensuring its own technological sovereignty at the expense of global market liquidity. As the silver-to-gold ratio continues to trend toward its historical norm, and the industrial demand for photovoltaic, AI, and EV applications remains inelastic, the physical shortage is likely to persist. The decade-low inventories in Shanghai serve as a warning. The vaults are not just empty. They have been strategically transitioned into the foundations of a new, resource-based economic order. For the West, the challenge will be to secure the physical metal required for its own green transition in a market where the primary supplier has already closed the doors.